Now, in a bid to control rising inflationary pressure from becoming entrenched, monetary policy authorities across the globe are working hard to confront stubbornly high inflation by accelerating monetary policy tightening. This development has made central banks in the US and UK and the Eurozone to raise benchmark interest rates to their highest level since just before the financial crisis 15 years ago, as the global economy is going through a sequence of shocks. The resulting swings in activities and prices have presented policymakers with a challenge of identifying turning points in their underlying dynamics at a time of disruptions in the economy and the financial sector. Joining me now live virtually from the United Kingdom to discuss this and other global contending issues is an investment and financial advisor, Mr. Gbenga Ogunrinola. Mr. Ogunrinola, it's good to have you join the program. Thank you for your time.
Thank you, Tolu. It's nice to be here again today.
Well, yeah, there seems to be a tsunami of interest rate hikes across the globe in a bid to tame the monster called inflation, despite the turbulence affecting the global banking sector. Now, do you see this move cooling off inflation amid global economic headwinds?
Yes, I remember that the last time we had a chat, I spoke extensively about the rising inflation and the various ways that governments of these countries have decided to also raise the interest rates so as to combat the inflation. And within the last 1 month, things have actually changed drastically. It all started with the financial crisis in the banking sector, where we had Silicon Bank and also the Credit Suisse following almost immediately. And that, in a way, kind of changed the old dynamics again in the world economy. And so before now, I mean, there had been governments predicting that they will continue to raise the interest rates. And most of those governments were thinking about raising those interest rates periodically by 50 basis points, have a look at what is happening in the economy, then raise it again. But with the events, in the last couple of weeks, it has made them to kind of rethink some of these policies and see what better ways to get this resolved. One thing is that when you concentrate too much in one direction, you might lose focus of certain things happening in other direction, and that was what happened. They discovered that probably the continuous hike in interest rates can hurt the economy, especially the banking industry, which in most cases are always the focal points of the economy. And so because of this, many of them are beginning to rethink and kind of rejig their policies such that probably the 50 basis points we're thinking about and the length of period that those interest rates will be increased. I mean, they had to look at that and see what other things can be done. So going forward, I don't see the kind of interest rates hike that we had seen in the last 4 quarters, happening again in the next 2-3 quarters. Most of them, they are going to change their strategies, and probably if they're going to increase interest rates at all, it's going to be just by just very few basis points.
Interesting ways to start this conversation. But both the U.S. Fed, where inflation currently stands at 6%, and the Bank of England are required to maintain inflation at 2% over the long term. Now, let's look at the measures now that you think the monetary policies are put in place to achieve this. For example, in Nigeria here, we've increased rates to 18% as we speak. Inflation continues to go higher.
So I think the Nigerian situation is always peculiar one way or the other. And I think in the past, I'd also maintained that we really need to rethink our policies, because what we are doing in the country, that's in Nigeria, is basically just postponing the evil days, let me put it that way. Because, when the economy is already having a high interest rate as high as 18% and inflation rate is 22%, I think what we should be looking at is how we can kind of stimulate the economy. Let's look at those areas where this inflation is actually, is high. I mean, let's look at those sectors of the economy where we have the highest rate of inflation and try to tackle those areas rather than just increasing the interest rates, because at the end of the day, I mean, we've spoken about the high cost of borrowing and how government has borrowed so much, especially this regime. We shouldn't be looking at increasing interest rates again. What we should be looking at is how do we stimulate the economy? How do we bring in the inflation down rather than increasing the interest rate? Because at the end of the day, all this, you're going to pay for all the rates you're increasing. And if the economy is unable to sustain it, it's like it just put the economy in a more tight and difficult situation. So I think we really need to look at our policy makers need to look at economic policy makers need to look at this thing rather than increase. I mean, are we going to continue to increase interest rates until it gets to 20-25%? I mean, I don't think that will go well for the economy. What we should be looking at, let's stimulate production. Let's look at ways to reduce, the effects of some of this inflation. What can we do? What areas can we, inject more funds to bring about this inflation rather than continue to increase the interest rates in the economy? And I think that is what the developed world, that is what they are tinkering with now. Rather than continue to also increase the interest rate, they are beginning to see, okay, how can we stimulate economy? Which area of our economy is actually being impacted majorly by inflation? Many of them, they've identified the energy area, and they are beginning to invest heavily in those areas. And that is why they can start talking about maybe reducing the inflation rate by probably 50% or even more than that between now and the end of the year. So I think we should begin to look at that. Countries like Japan, I mean, when you look at their interest rates, it's in the minus region. How are they doing it? I think those are things that we should begin to look at and see how we can, borrow leave from some of these countries, what they are doing to ensure that they are able to curb the inflation rates in their economy and also maintain a low level interest rates. And of course, with this, it's also going to affect the stock market generally, because when you can get easy funds, easy returns with 18% per annum, I mean, in the money market, why would you rather put your money in the capital market where it's so uncertain of what returns you will get? So that is what we are dealing with. And I think our policymakers need to really do something about this.
Interesting stuff, as usual with you. But let's take it further. Major issues facing financial systems include inflation, we've talked about that, at multi-decade highs, continued deterioration of economic outlooks in many regions, and persistent geopolitical risks. There are a lot of issues at the moment, even brewing, aside the Russia-Ukraine crisis, which we've been grappling with for more than a year now. How does this douse the tension in the banking sector? Look at the recent turmoil with the Silicon Valley thing. What message does this send? Do you think the confidence in that system remains?
So a lot of economies are really very careful now, and they are beginning to be more careful with policies and also trying to also do better in the way they regulate their firms, especially the banking industry. The searchlight is on the banking industry generally now, and it's also exposed the fact that the economy of most of these developed world are very fragile now. And so many of them, they are very careful with tweaking anything in the economy because they know that there could be a ripple effect, generally on the economy. So they are trying as much as possible to see how they can regulate, at the same time looking at the various policies that have been implemented in the past few months as a result of inflation, and see what can be done, to see how to kind of have a balance, in every sector, not just having one sector, being attended to while the other sectors are not in any way attended to. So it's a general holistic thing that they are trying to do now, trying to be more conscious with their regulations, trying to see how they can ensure that every part of the economy is not left out. And with that, I believe that they might maintain some level of stability in the economy. But generally, the world economy is on a fragile state currently. And I think everybody is careful so that we will not have a repeat of the general global recession that was experienced around 2008, 2009, some years back.
Indeed, many will say there shouldn't be a repetition of that ugly incident. But let me take you further. China, the big engine, the big room where all of the work happens, thanks to COVID and all the challenges they face. But I think they are returning gradually to pre-COVID levels. Now, I just want to ask you what impact this would have on the entire sector, because when China sneezes, the whole world catches cold, just like the United States.
Yes, I think China easing up their economy and going back to production has actually helped the general world economy. I mean, if probably China was still in the limbo and still grappling with COVID, what we are talking about now would be worse. But that has kind of, they are coming out of the COVID and beginning to produce again. That has kind of given some level of confidence, to the world economy. China is very high on commodities, and that has also stimulated the commodity markets. And also because of the high level of usage of energy, oil, and all that, it has actually also helped in that aspect of the market. So, I mean, oil prices and all that, it's helped in a way to kind of stabilize that also. So China's coming out of their current lockdown has helped the world economy, and that has kind of given a sort of lifeline to what we're experiencing now. And hopefully, if that continues without having any drawbacks again, maybe we might see at least some level of respite when it comes to the general global economy.
Now, given the uncertainty and grounds of tightening policy, how will this play out, looking at the impact on the performance of the stock market, investors' confidence, and the global economic outlook for the year 2023?
Yeah, so, the last time we spoke, yes, I had made mention that the outlook for the global stock market looked very impressive. And I remember as at that time, we had a number of stock exchanges having a very good year-to-date return on investments. But as we speak now, it's a different story. Most of the stocks exchanges have started having decline. I mean, we start from the Nigerian stock market. I think the last time we spoke, we were on about 6%, 6 point something percent. Year-to-date, it's declined now. It's snowballed down to other areas too. I mean, if you look at the FTSE too has lost ground. The last time we spoke, it was in a positive territory. Now it's about minus 1.09% in the negative territory. Same thing with the FTSE 250. It's lost also about 3% year to date. In the United States, there's also been some drop. Before now, the Dow Jones was in a positive territory. Now it's on a negative territory. S&P and NASDAQ have managed to retain that positive territory, with NASDAQ still having at least as high as 13.49% year to date. But, generally, we can just see that level of decline from the last time we spoke till now because of what is happening globally. And many of the banking stocks have been hit by this because people are beginning to now look at the banks as, are they really as strong as we think? The high interest rate regime, is it really affecting and impacting them negatively? And of course, when some of these things are very contagious, so when something starts happening in one bank or in one territory, it snowballs to the other areas, and that's what we're having. And that has actually affected the FTSE most, because unlike most other exchanges where you still see some level of gains for the FTSE because of the banking stocks over reliance, and they have a large percentage of the quoted companies in the banking stock area, so that has actually affected them. So that's the way it's been.
So, speaking to investors now and those that have the hot money, they are ready to spend this money, moving it from place to place, what would be your advice to them considering the challenges we face at the moment globally?
Yeah, so I would just say that I mean, investors need to be careful now and look at things critically before before coming into the market. So it's not something that they'll just delve into the market. They need to look at all the dynamics and ensure that all things are going well before they put their money into the market. So I think for investors, they need to really look before they leap. This is the time to really do that. As the world economy is very fragile now, and things are happening very fast. I mean, within just 1 week, there's so much changes already in the world economy. So it's like anything can happen, and one should be very careful before putting money into any form of investment.
Indeed, we
this time
must
around.
tread with caution. Thank you so much, Mr. Gbenga Ogunrinola, investment and financial advisory, joined us from the United Kingdom. Do enjoy the rest of your day.
Thank you, Tolu. It's always a pleasure.